So, the Fed just cut rates for the third time, and everyone's calling it dovish. Well, I kinda disagree for now. Powell basically said the cutting cycle is over, and if you're positioned for more rate cuts, you might be walking into a trap. Alright, look, if you're short on time or you'd rather not listen to some random cat guy on the internet, here's the one thing you need to know. The Fed brought rates down to 3.5 to 3.75%, and Powell explicitly said they're now in neutral territory. And what does that mean? Well, don't expect aggressive cuts in 2026, but the market is pricing in 2 or more cuts next year, while the Fed's own dot plot says 1. Somebody's going to be wrong, and historically it's not the Fed. Okay, still here? Alright, let me walk you through what this actually means for tech stocks heading into the end of the year. And hey, welcome back to the channel, or if you're new here, welcome, I'm DataCat. For those who don't know me, I spent years as an analyst inside a Fortune 50 company. You know, the whole corporate grind thing, then eventually traded all that for, well, lasers and keyboards. And cats. Mostly cats. Speaking of which, I actually just got back from Tokyo, hence the week-long disappearance. Apologies for that. I needed a break. The food was incredible, and honestly, coming home to discover my cats didn't even acknowledge my existence was humbling. Like I was gone for a week. Nothing. Not even a slow blink. They just looked at me like I was room service that showed up late. Anyway, this channel's about 5 months old now, so I'm still figuring things out. But my goal is pretty simple. Break down macro and market data in a way that actually helps you make decisions. Not just noise. Not just vibes. Real analysis. So if that sounds useful, stick around. Maybe hit subscribe if you're feeling generous. No pressure though, except for the fact that my cats are judging me. Alright, let's get into the December FOMC and what it means for your portfolio. So, quick context. The Fed just delivered their third consecutive 25 basis point cut, with 75 came in the last 3 meetings alone. Now I'm actually seeing some YouTube titles calling this dovish. Oh, the Fed's easing risk assets to the moon. But if you actually read Powell's comments, and I did, because apparently that's what I do for fun now, the tone was very different because Powell just explicitly said, and I quote, "Policy is now well positioned to wait and see how the economy evolves." That's not dovish language, that's pause language. He even called this latest cut a close call. Now let me give you the Fed's actual read on the economy. On growth, they're projecting real GDP at 1.7% in 2025, rising to 2.3% next year. Consumer spending is solid. AI and data center capex is supporting business investment. Housing, still weak, classic mixed bag. On the labor market, official unemployment is around 4.5%. But Powell finally flagged something important. He thinks payroll data are overstating job growth by roughly 60,000 jobs per month, meaning underlying job growth could actually be negative. He's openly talking about rising downside risk to employment. That's not nothing. On inflation, headline and core PCE are both around 2.8% year over year, down significantly from the 2022 highs but still above the 2% target. Powell attributes most of the remaining overshoot to tariffs on goods. He said if you strip out tariffs, inflation is in the low 2s. The baseline assumption is that tariff-driven goods inflation peaks around Q1 2026, then fades, assuming no new major tariffs get thrown into the mix. So what's the takeaway here? This was a neutral cut, not a dovish pivot. The Fed brought policy from restrictive to neutral, and now they're signaling they want to stop, unless the data forces their hand. Now here's where it gets, let's say, interesting. Why? Well, here's where the disconnect shows up. Currently speaking, the Fed's own dot plot has one more cut penciled in for 2026 and another in 2027. That's a very shallow path lower. But money market futures? Traders are pricing in around 70% odds of 2 or more cuts in 2026. That's much more aggressive than what the Fed is advertising. So there's a gap. The Fed says one more cut, maybe. The market says nah, you'll cut more. And some sell-side commentary is arguing the cutting cycle is basically over, that any additional 2026 cuts are conditional on the labor market getting significantly shakier. Now, who's right? Historically, betting against the Fed is a losing trade. But Powell did leave a door open. The labor market story really is soft. He's openly discussing potentially negative true job growth and elevated downside risk to employment. That's the one channel that could justify more cuts than the dot plot currently shows. For tech stocks, here's a quick read. The discount rate tailwind from here is probably diminishing, not accelerating. Further upside in growth and AI names has to come more from earnings and actual productivity gains, not from hoping for extra dovish surprises. Unless employment deteriorates faster than expected, then all bets are off. So, let's look at the tape. QQQ as of Wednesday, the current price is $627.61. We're sitting about 1.5% below all-time highs near the very top. And moving averages? All bullish. Price is 1.7% above the 20-day EMA at 617, 2.4% above the 50-day SMA at 613, and a whopping 14% above the 200-day SMA at 548. More importantly, both the 50 and 200-day slopes are strongly positive. Medium-term trend is clearly up. But the momentum gauges? This is where it gets nuanced. RSI is at 60, bullish but not extreme. Money flow index at 56.8, moderate positive flow, no blow off top. Stochastics, K and D both around 93, that's short-term overbought. MACD histogram is positive but falling, which means trend is up, but momentum is slowing. So what does this tell us? This is uptrend with a grind, not a parabolic melt-up. It's stretched enough to justify consolidation or shallow pullbacks, but not screaming reversal. And there's one mild caution flag. The 10-day up-down volume ratio shows heavier volume on down days. This is not a classic distribution but worth watching, like when your cat stares at you while slowly pushing something off the table. It's not a crisis yet, but you should probably pay attention. So here are the key levels to watch. First, the resistance cluster, 624 to 637. Then the support zone, 615 to 618, which is the Fibonacci level meeting the 20-day EMA. And the deeper support would be around 605, then 580 if things get ugly, but no need to worry too much for now. So, here comes the question. What could interrupt the Christmas vibes? Well, a couple of things. First, event risk. We've got November CPI, jobs data, and the PCE price index coming up. These are key inputs to the Fed's path. And Powell himself warned that due to the government shutdown, some of this data, especially CPI household surveys and labor metrics, may be technically distorted, not just noisy. That raises the odds of surprise prints in either direction, and probably some overreactions because nobody fully trusts the data quality right now. Second, seasonality. December isn't uniformly strong. Historical data shows it often splits into 3 phases: firmer first 7 trading days, softer middle 7 days, then the actual Santa rally in the last 7 trading days, typically starting around the 15th trading day, which this year falls on Friday, December 19th, which also happens to be the OPEC date. And here's something most people don't talk about. Historically, the Santa rally favors the S&P 500 over the Nasdaq, so if you're banking on tech leading the charge into year-end, history is not on your side. Third, cross-asset signals are mixed. Equities initially cheered the cut. Dow was up about 0.7 to 1%, S&P up modestly, but Nasdaq mostly flat. Crypto sold off. Bitcoin and Ether both down around 3% as the Fed's cautious tone tempered rate cut expectations. Gold and silver hit record highs. I'm not saying this is bearish, but that's classic hedging behavior, not full risk on. The fear and greed index is still at 36, that's in the fear zone. This delivers a clear message. Risk appetite remains constructive but cautious. For a QQQ-led Santa melt-up, you'd want less hedging and more outright chase. We're not quite there yet. Alright, putting it all together, here's my probabilistic thesis. Not a single deterministic call, because again, anyone who tells you they know exactly what's going to happen is either lying or selling something. Possibly both. Base case, in the near term, sideways to mildly down bias, QQQ oscillating between roughly 615 to 618 on the downside and 637 on the upside. Expect gap and fade action. Traders selling strength near highs, buying dips into the 20-day. Classic chop, late December after the OPEC day. If macro data comes in roughly in line or slightly soft supporting the rate cut narrative without triggering growth scare, odds favor a modest Santa rally. QQQ making marginal new highs above 637, potentially stretching towards 645 to 655. The move is more likely to be a low volatility drift than a vertical squeeze, given current compressed realized volume, and the bull case, which would be cleaner Santa squeeze. This requires benign CPI and PCE prints, orderly labor softening without unemployment spikes, and AI megacaps meeting or beating expectations. If all that aligns, QQQ could break decisively above the 52-week high on strong breath, trading more in the 640 to 665 range into year-end. I'd assign this lower probability than the base case. Powell's messaging was explicitly cautious, positioning in big cap growth is already heavy, and seasonality historically favors SPY over QQQ during the Santa window. So that's where we stand. Fed's done cutting for now unless employment cracks. Markets pricing in more easing than the Fed wants to deliver. QQQ is in a healthy uptrend but stretched short term, and the Santa rally, if it happens, is more likely to be a drift than a moonshot, and probably favors the broader market over tech. Keep your eyes on CPI, PCE, and jobs data. That's what's going to move the needle. Alright, that's it for this quick post-FOMC update. If you found this useful, consider subscribing. I'm trying to build something here, just me, some data, and cats who couldn't care less whether I exist. Classic. Thanks for watching. DataCat out. Stay sharp and stay safe out there, and I'll see you in the next one.